So if we go through your here, okay, to some extent the stuff that is out, the readings I've updated the readings, so please make sure you complete the readings. Okay, these are backup along with the video and the class notes, which are pointers to what is being covered. All the decision problems, okay, so I've given you this kind of structure. You will generally not find this kind of structure in any textbook, okay, but I've given you this structure because you're just, you know, like babies being thrown into the water. So I've given you some kind of structure where and these decision problems are clear, and I've given you a structure as to how you're going to solve the decision problem. As to how you're going to take an eyeball view, that you have to get used to. An eyeball as far as where is the optionistics? Oh, that means this is here. Okay, I forgot to. I don't know if I pull this back, will it actually see? I don't want to. Anyway, now we are stuck. Return to previous page. They've given us an option. I made a big mistake. I should have actually loaded that back. I'll just switch to my just temporarily. Actually, I made a big mistake. I shouldn't have done that. Anyway, I think doesn't matter. Let's look at a shorter eyeball chart. Okay, let's look at this chart. Here's your eyeball chart. Okay, you know how to get there. If you want to change the ticker, you change the ticker here. Just go here and just enter whatever you want to enter. Facebook, enter that. Okay, and then the numbers will change, as you will see. Right? You can see the numbers have changed. And then you come here and take out the wall chart, the eyeball chart. Okay, so you can see the eyeball chart here. So you have to take a view on this. And as far as the view on eyeball is concerned, as you know, generally you can take views using either a fundamental approach or a technical approach. Okay, but in eyeball, as far as the eyeball views are concerned, it's very difficult to get a fundamental view because you don't have the raw materials, okay, to form a fundamental view. So the eyeball view, almost you have no choice but to use a technical approach to forming a view on the eyeball, which means you're just looking at the trend of the eyeball and taking a view on which way it's going to go. Because the fundamental information that, you know, the market structure, that is not even actually fundamental information. It's really, it's kind of very difficult to put it together. So it's much easier to take just a purely technical view. But this problem is always going to remain. Like, how do I know whether it's going to go down or up? Well, you never know anyway. And no matter how much you study and no matter what predictive model you use, you're never really going to know anyway. The degree of accuracy and reliability is not really going to change. Okay, so this is the basic uncertainty of life, and this is the same thing that applies to even the markets. Okay, so here now, what's going to happen to the dollar Swiss? No one really knows, and you'll never really know anyway. Okay, it's not possible to know. That is, even if you understand that, that's actually a big realization, because many people don't understand that. They keep on experimenting with more sophisticated models and things like that, thinking that they will find the right answer. But no predictive model is really going to work. So if you once you understand that, you have a better. It's almost like a coin toss, basically. It's almost like that. Okay, maybe you can get a little bit better accuracy, but that's not so important, because if you ride your winners, if you cut your losses quickly, and when you have a profit, if you keep riding the profit, you can still make money. Remember that? You remember the system edge calculation, right? You remember the system edge calculation?
Yes, sir.
So the point I'm trying to emphasize here, I got this. I really do not like to see this sign. So let me see if we can. Even if, I mean, I don't even know if this is going to be able to connect over here, because remember we had problems.
Your USB server is blocking.
Yeah. This is so far. This is the firewall that they've come up with. I don't know why this optionistic site is blocked. Actually, they have come up with categories. You know, strange categories. So even news sites are blocked. So if I'm connected, sorry, I actually need. I need to tell them to.
So you can also use a Chrome embedded extension to bypass it.
Bypass the firewall. Oh, okay. There, I didn't know there was a Chrome inbuilt official Chrome extension.
So there are actually it's not official extensions. There are extensions named as VPN.
Okay, VPNs.
You
Okay.
check which VPN is allowing you to bypass this.
Okay. So instead of having a specialized VPN software, you're talking about a VPN as a extension to Chrome. Achha, I didn't know that you had Chrome extension type VPNs. Okay, so now we have our Microsoft chart back. Okay, so this works. Now unfortunately this is a problem. I don't really need this for the rest of the class. And now that I've got it, I'll go back to, I don't really need anything else. No, this is okay so far. Let's see if it causes a problem. Then we'll go back to it. I have to upgrade my Geo now from 2 GB to 3 GB because it's sometimes I have to work with it the whole day. And okay, we'll get this fixed. Don't worry. Okay. So what was I saying? We were talking a little bit about the. Let's go back to this. We drifted a little bit. We were talking about. I suddenly started talking about your predictive models. Okay. So why is that? Now I just want to give you a brief idea. I don't want to make you feel depressed that we don't want to. We never know how to. We'll never know how to. Where did I put System Edge? Yeah. So this is in the previous. Yeah. You remember this? I don't want to make you feel depressed because I was saying that since he's talking about predicting, okay, so we started the discussion from here. Let's say we have a longer eyeball chart. Now what I'm trying to do is to try and form a view on the eyeball to figure out whether I want to be a buyer or seller of options. Okay, so how do I form a view on the eyeball? It is pretty difficult to get information on what options are trading in the market. You can make a fundamental connection, but by and large you have to use technicals, a sense of how the market is going to move. So this instinct, that's why I've asked you guys to think of it as a like a surfer, right? Like a surfer doesn't have a PhD in fluid mechanics, but a surfer has a pretty good feel for the waves, right? So that's why I've told you, because you really don't have, this is not physics, so you don't really have any reliable models that are going to work. Okay, so you have to develop your instinct, but your instinct can always save you. Okay, your instinct can always save you. So therefore, so don't. I would strongly urge you to rely a lot on your instinct, because a lot of the time what happens in the MBA programs is we teach people quantitative techniques and things like that. So people are almost being given the subliminal message that instinct is not important. I would give you the counter message, especially when it comes to markets, economies, etc. Especially when it comes to markets. If you have been watching markets for a long time, okay, so you should learn to trust your instinct. Everybody, you heard that concept of the sixth sense, right?
Yes.
Everybody, when you keep on watching something for a long time, you will develop a feel for it. It's a natural human ability that everybody has. Okay, if you're watching something intensely for a long time, if you're watching the Microsoft stock prices for a long time, you will develop a feel for it. You will develop if you're really intensely into it, you will develop a feel for it. And that feel, I would strongly urge you to. You should trust that feel, because that is actually a very high quality, and that is pretty much the most high quality kind of analysis that you can get in the markets. Okay, so I would strongly trust you. You can use other tools also. You'll obviously use risk management tools. The main message I'm giving you here is don't disregard your own instinct about markets, economies, anything that you're following very closely, very intensely. Over time, you'll develop an instinct for it, and learn to trust your instinct. This is very important. You should trust your instinct. Like Kushbu's instinct will be different from Gulati's instinct, and that's fine. Both of you should learn to trust your instinct. You shouldn't worry about what she is doing. You should trust your own instinct. Okay, so this is an important message I wanted to give you. Are you following what I'm saying? Yeah.
So
Yeah.
is it regarding if we are referring to an eyeball, or is it regarding the overall price or the market?
See, it refers to both. This statement that I'm making about trusting your instinct, that's why I said you follow the markets. Think of it like a surfer. Okay, here in option trading, you have to take you have to take some other views also, but mainly the major views that you have to take are the view on the underlying asset, which way is it going, and the view on the eyeball for that particular asset, right? So here, if you're trading Microsoft options, you have to take a view on the common stock of Microsoft, which way is it going, and you have to take a view on the eyeball of Microsoft options, which way is that going. This quickly red line, which way is this going to go, that also you have to take a view. So both these things, I would say, You can work on some other more structured methods also, but override, that is not mutually exclusive with instinct. That does not necessarily exclude instinct. You use your structured methods also, but you also listen to your instinct about what it says about the market, right? So, for instance, so that's what I'm saying. Does it answer your question? Okay, so instinct is very important, because generally the reason I want to emphasize this message is, the general message that goes out at MBA programs and any kind of things is that you should use quantitative methods, this, that, okay? But I would say that this is not physics, so you can't rely on quantitative methods. So therefore the role of instinct is very important, okay? If you are flying a plane, even in the planes, they say some pilots rely on instinct. Like there was this case, you remember, where in New York there was a bird hit. There was a plane landing at New York, and there was a bird hit. So the plane obviously was not functioning properly. So what the pilot did was, he landed in the Hudson River. So he basically took over, he disregarded all the rules and all that, and because he was a very experienced pilot. So he just told the airport that the emergency staff that we are going to be in the Hudson. And he landed that plane on the Hudson River. And no injuries, not even any major injuries. So all that is a lot of instinct. So even at things like plane, which is 100% science, there's no real instinct, there is 100% science. Even there they are using instinct successfully. Okay, so therefore in the markets, definitely you should trust your own instinct. Okay, and so yeah, so what was I saying? Right, now I told you something about I just want to emphasize something. I said that because you will not have most of the models that you'll see, eventually will have only maybe 50-55% accuracy. So that should not make you feel depressed, because go back to, I hope you haven't forgotten what system edge is. Remember what system edge is? Yes, Aurora? System edge, does anyone remember?
Yes, sir.
What is it? Use the mic. Where's the mic? Do you remember what system edge is? Can you explain in simple terms what system edge is? If I say my system edge, if I say that my and again system edge is always can be both ex ante and ex post. Okay, let's say for last 1 year's my dollar Swiss trading system, if I'm referring to my dollar Swiss trading system for the last 1 year, the ex post system edge is $1,700. What does that mean?
So that means that your total risk that will be divided per trade is amounting to $1,700, whatever that amount is. So you will distribute that amount per transaction, and that risk amount only you will take.
No, that's not what system edge means. Anybody else remembers? You've forgotten all these basic important concepts of trading, managing. You're going to look at asset management positions. Anybody else remembers what system edge is? This is an important term in the markets. Yes, Mehak? It says here, you can see here what system edge is. I'm looking at the formula.
It is average loss into...
No, now you're telling me, you're reading out the formula. But what is it actually? Now this is similar to what kind of concept in statistics? When I discussed this, I said it should remind you of a particular concept that you study in statistics. What is that concept?
Mathematical expectation.
Correct. So the statistical concept that is identical to system edge, actually identical, mathematically identical to system edge, okay, is mathematical expectation. Okay. In statistics, when you're taught this concept, you're taught this concept as mathematical expectation. That is summation pi xi. Right? So here we use, for pi, we use the percentage losses and the 1 minus percentage losses. Okay, for the probability of loss. And 1 minus percentage loss is what, Aurora? What is 1 minus percentage loss? Another way to express 1 minus percentage loss is percentage wins. Okay, so percentage wins we don't write separately. Okay, so this model of mathematical expectation, how many exogenous, let's do some revision. This model of mathematical of the system edge, this model of the system edge, how many exogenous variables does it have? Puneet, is my question clear? Here we are modeling system edge. Okay, so this model of the system edge, how many exogenous variables does it have? 1 minute, let Puneet answer. And what are they? Does this formula look unfamiliar to you? You want me to increase the font size? Now you are doing big data, no? You want to see big data.
Big data.
Yes. Yes, Puneet. Any idea? Is my question clear? 3. And what are they?
Loss.
Loss. Okay, then? Yeah? No, percentage win and percentage loss are not separate. When you're talking about exogenous variables, you have to always talk about, if you wrote this equation as, if you said that there are 4, you're correct that there are 3. Percentage win and percentage loss are not separate independent variables. Here, the independent variables here are average loss, average win, and percentage loss, because given the percentage loss you can figure out the percentage win. So you don't say that this has 4 independent variables. This is only 3 independent variables, because the 4th one can be expressed as a function of a constant and the 3rd independent variable. So therefore you don't mention it as a separate independent variable. Okay, so this has 3 independent variables. So just we are doing some revision on your basic model theory and all that, right? So the reason you should not feel depressed, so what was I saying? I was saying that you have to trust your instinct, and by and large, no matter what you do in terms of highly sophisticated predictive models, mathematical models, they will still they're still susceptible to having a very high error rate. So that should not make you feel depressed, because you might feel depressed and say that no, I can't trade because I can never be getting it right. Okay, why? See the structure of this equation. First, understand what system edge is. What Tarun said about system edge is not correct. The mathematical treatment is correct. System edge is the mathematical expectation of your trading system. Okay, system edge is the mathematical expectation of the trading system. And what is mathematical expectation in terms of, it's a weighted average. When I taught you mathematical expectation, when we revised it, did I say that it's a probability weighted average outcome?
Yes, sir.
Okay, it's just a weighted average where it's instead of just giving a simple average weighted outcome, average outcome, you are weighting it by the probabilities. Okay, so system edge is basically the average profit of your trade, of your system. Okay, so in this system, if I say that my system has, if we go back here, okay, we go back to your, where did we calculate all this stuff? There is. No, this is cap markets. It's also, wherever it is, I don't know why it's not there.
Calc folder is not here.
No, this is your calc folder.
No.
Here, it must be here. No, not even here.
It's not here. The one we looked in for IPM is not here.
Yeah, something like this, okay?
Yeah.
So if you have this, so system edge, what does system edge basically mean? So this is also an important concept. Just because you have a very high, the chances of getting a very high percentage win figure is very low. Okay, most people have very low percentage win figure, but that does not mean you should get depressed, okay, and forget about trading. Why? Because look at this structure. So first understand what system edge is. Okay, system edge is the average profit of your system. Okay, this 75,000. Okay, now what is the gross profit? Look at the gross profit of the system. This is very important, which is, now we are talking about this here. So 18 minus 4.5, essentially, can you see this? We are calling it gross profit because if you tally up all your losses, it's 4.5 million.
Yes.
If you tally up all your winners, it's 18.5 million. Okay, and your therefore your gross profit is 13.5 million. Is that okay? All right. Now, what is another way? So this is one way of arriving at your total profit, your gross profit. Okay. So if you take this and then you divide it by the invested capital, which is here. Okay, invested capital is $5 million. Okay, so if you're looking at your return on invested capital, the way you get that is by taking this gross profit, and divided by your invested capital, $5 million. Is this clear? You remember all these terms?
Yes.
Invested capital.
Yes.
So basic figure that one of the most important figures that we report for an asset management operation for any fund is that what is the return on invested capital, right? And how do you arrive at that? Basically, you take the gross profit and divide it by the invested capital. So you get the total return on ROIC here. Where is the ROIC? That we can just write it here. We can take the gross profit and divide it by the invested capital. Okay. What happened here? This has to be a Is this clear? Because on an invested capital of $5 million, you have made a profit of $13.5 million. So your return on invested capital is 270%. This is clear?
Yes.
Okay. So that is the importance of that figure. Now, where does system edge come in? What is another way of arriving at the estimated gross profit? So this gross profit is an important number. This is only shown estimated because this is an ex ante calculation. Okay. Now, what is another way of arriving at the same 13.5 figure? That is, you take the system edge. In this case, system edge is 75,000. What is the total number of trades? 180 trades. You do not multiply the system edge with only the winning trades. You multiply it with the total number of trades. Okay. So if you do this, basically 75,000. You can see here, if you do 75,000 into 180, you will get this. Okay. If you do here as a test, you'll get the same 13.5 million. Is this clear? Okay. So one, gross profit, you understand, it's a very important concept. Add up all your losing trades, add up all your winning trades, and hopefully the winners are more than the losers. So you have winners minus total losers is your gross profit. That you divide by the invested capital, that is your return on invested capital, very important number for a fund. Another way of arriving at the gross profit is to look at the system edge and multiply it by the total number of trades. So the system edge is basically just the probability weighted average outcome of your system. So the concept doesn't change because it is still the mathematical expectation. So when we say that mathematical expectation is nothing but a probability weighted average outcome, okay, but it's a probability, it's a weighted average where the weights are the probabilities. So similarly, this is a mathematical expectation of your trading system. So the probability weighted average outcome of your system is $7,500. Or what is it? $75,000. If you multiply that by the total number of trades you have done, you get another way of getting at the gross profit. Yes? Clear?
Yes, sir.
Okay? So now this is why I just wanted to refresh. As you can see, you guys have lost a lot of this. So these concepts should have been already internalized totally. Okay, these are important calculations in running a fund, which and you will not find these in any textbook. So it's better you internalize all this stuff here. Okay. So now why did I discuss system edge? Because I wanted to make sure that you don't get depressed just because the hit rate of most systems is quite low. Percentage winners for most systems is quite low. This percentage losers for most systems, as I told you, for myself, when I'm budgeting at the beginning of the year, I always put this as 75. Although I've never had 75%, but I always make it very, very ultra conservative. Okay, so 75% losers, and that's how I work. So generally, most systems will have a pretty high loss rate, anywhere between 60 to 70%. Okay, so you should be, but doesn't matter. Okay. Even if you have, let's say if you have 75% loss rate, the point I'm trying to show you here is why you don't have to get depressed. Even though your percentage losers are very high, okay, all right. But if you can maintain, what is R3? Remember R3? Why it's still possible, even with a high loss rate, it's still possible to make good money if you are able to capture big trends. Are you following what discussion we are having now? Are you seeing the relevance of the discussion? Yes? Why is it, what is R3? You've forgotten what R3 is. Yeah, so R3 is, can you be more specific? Ratio between profit and loss is fine, it's a layman's answer. Can you be more specific in terms of actual variables? Yes? Average win by average loss. That's the answer I was looking for. Okay, so R3 basically is average win by average loss. Maybe see, let's see if we have an answer here. Target R3 here, that's the input figure that we have. But essentially here we can just go back to this system. In this system, what is our average loss? Average loss is here, okay, 41.667. So our R3 is, and what is the average win? $250,000, okay? And average loss is 41. So R3 actually for this system is, we can even increase this a little bit and see it's exactly 6, okay? So there was one question for you on the in terms where the R3 was required to be derived. It came out to be 13.5 or something like that, okay? But that's not important. But the main thing is that to do these calculations, your concepts about all these things should have been very clear. Okay, so that question only I think Sakshi Jain and Tarun got right, I think, or maybe Sushi also got it right, I'm not sure. But that question very few people got right, although it had been done in the class. But you have to internalize these concepts so that you are totally clear about all these things. This is not so complicated. It's not like I'm teaching you nuclear physics or something like that. It's just something new. So obviously if I'm teaching you something new, you have to study it properly, then you have to revise it through 3 times, and only then does it get internalized. It's nothing so complicated. It's a quite simple calculation. I'm sure you do these calculations anyway in your daily life, similar calculations. But you have to be clear about what we are doing, because these are all important concepts, there are concepts also involved, like you have to know what system edge is, right? So now you see the R3 of this system is 6. Okay, so even if you give the system 75% loss rate, okay, the point I'm trying to illustrate is that you can still have your total profit of the system will be high if your system edge is good. If you have a high system edge, figure, that means even then, even with a high loss rate, if you have a high system edge figure, then you'll still make a decent amount of money. Is that clear? Because your total gross profit is system edge into number of trades. Yes or no? Total gross profit is system edge into number of trades, right? So if you do a reasonable number of trades and you have a high system edge, you'll still make a decent amount of money. The point I'm trying to show you here, that system edge can be high even if percentage loss is low, as long as the percentage average win, essentially R3, another way of saying R3 is basically relationship between average win and average loss. Okay, if you have a high R3, which means basically on average, if your average win is much bigger than your average loss, okay, then you will still make money. Even if you can still make money even if your percentage losers are low, percentage losers are very high. Are you following? Yes. So in this spreadsheet, if you go back to this spreadsheet, what we are showing is percentage losers is very high, 75%. You have 180 trades, but because the what is the average system edge, you can see now has dropped. Earlier we were looking at $75,000, now it has dropped to $31,000. But still, the point I'm trying to illustrate here is that typically a layman, when he sees a system with a very high loss rate, 75%, have you noticed this? When you're looking at charting websites, there are ads coming up, internet ads. They are trying to sell you systems. Others is falling asleep. We have to do some Rajasthani puppet style, some activity on him. Come, let's have some movement. Come here. Come and sit here. What happened? You're leaving.
My grandmother is serious.
Okay. Okay. All right. Okay. Come here so that you will not fall asleep. You get some movement. Okay. All right. Okay. So where were we now? So you can see here that the loss rate is very high. Okay, 75% loss rate, but still we have a positive system edge. Do you see that? The point I was trying to, where I got lost was, most people when they look at a high loss rate system with a high loss rate, they'll think this is a bad system. Not necessarily so. You have to really look at the system edge. One of the important things, you have to look at the system edge, okay? And you'll notice that what I'm saying is when you go to these kind of websites, right, like this, you're using a market website, they'll give you some ads, and you'll see very often people are selling ads on, like here you see some ads sometimes, okay? You'll see that people are selling systems. They are selling trading systems with a very high win percentage. You should be able to detect this for yourself so that you're not fooled like ordinary people. Normally what happens is when people are selling trading systems because they want you to buy the stuff, obviously, they are going to make you believe that it's good by showing you that it has a very 80% accuracy. If you see, most of the time when people discuss trading systems, they say, oh, your system 80% accuracy, great system. That doesn't really mean necessarily, guarantee anything, because if you have the R3 is also important, the relationship between average win and average loss, okay? Which is basically, so that the point I'm trying to illustrate is that, are you following? Did you get what I said? So if your average win in relation to average loss is very high, even with a high percentage loss, you can have a high system edge, okay, which is what you see here. Because the R3 is 6, okay, the R3 is 6, which is average win by average loss, okay, because the R3 is 6, therefore even though the percentage losses is very high, the system edge is still a decent system edge, and you're still making 113% on your risk capital, on your invested capital. This is clear. Normally, when the point I'm trying to illustrate is that the average person who does not have this understanding of R3 and system edge will look at a 75% loss rate system and say, oh, it's such a bad system. But that is not a correct assessment. That is not the right way to assess the system. That's what I'm saying. Similarly, a system that has a low loss rate doesn't necessarily mean that it's a good system. Okay. So that's what I was saying. It's a long discussion, but it's important to have the discussion because I started out by saying that you have to trust your instinct. Most quantitative mathematical predictive models will not have a high win rate. Okay, forecast accuracy will not be high. That's why you have risk management, which is very important. Risk management becomes very important, and part of the risk management and the return management also is managing this. Okay. And where does this dynamic come from between the average? Where does this 6 number come from? Where does this 6 number come from? Remember bracket orders? Let's do a quick recap of basic trading mechanics. Suppose I'm going long dollar Swiss over here. Okay? Let's say we make this even bigger. Let's make it a bigger view. What happened? So it's a very slow PC now suddenly. Okay, so let's say my view on dollar Swiss is bullish, okay, it is actually bullish, okay. So now suppose I go long at market at 99.70, okay, 99.70 I'm going long at dollar Swiss at market, okay. So if I'm going long dollar Swiss, what am I going long? Swiss or dollars? Dollars, right? So dollars is the base currency here. So dollar Swiss, I'm going long US dollars, and let's say my stop is at 0.9, okay? 0.9 is my stop, and I go long here. So where does this R3 dynamic, remember, so one of the things we can do is we can place a bracket order kind of structure where we have a stop here and a take profit somewhere, right? Remember that? Okay, so one of the decision problems which we never really addressed, we didn't have time to address while doing IPM is, where should I place the take profit order? Because we discussed using a trailing stop and things like that. But one of the decision problems for those who don't want to place a use trailing stops and you want to use targeted take profit orders, right? So one of the questions then you have to decide, where should I place the take profit? Do you realize that becomes another decision problem? Yes? Okay, so that's where this ex-ante planning comes in. Suppose you are planning out this system, okay. Suppose you are projecting the system will have 75% loss rate, and you are projecting that you will do 180 trades, and you have figured out with your other type of calculation, you have arrived at the average loss, which is based on your total risk, the distribution of losing trades, okay, and plus 1, etc. With that you have arrived at the average loss. Now, so obviously when you decide the position size for this trade, I'm going to go long at 99.70 and I'm going to stop at 0.99. Okay, so I will make sure that my position size is such that I don't lose more than this $42,000 on that trade. Are you following? What is the role of the average loss guideline? Average loss, the maximum loss guideline, which we are taking as average loss. The role of that figure is that when I decide my position size, I'm buying at 99.70 and stopping out at 99, so I'm losing 0.007. Okay, 0.007. Then what is the amount of dollars that I can afford to buy? Given that my loss should be equal to only $42,000. Okay, so I will also adjusting for the fact that the loss, when you calculate the loss initially, it will come in Swiss francs.
Yes.
So you have to convert that into dollars, right? Are you following the logic? Okay. So the role of this figure is it helps me to decide the position size, right? But suppose my investor has told me that you need to deliver 113% return on invested capital. Suppose my investor has told me that I need you to deliver 113% return on invested capital. Some such discussion will happen in every fund. Okay, maybe not so precise, maybe something around average. Some such discussion you follow. This is a relevant point. The investor will have some expectation. Suppose my investor has told me that I need to deliver 113% return on invested capital. Okay, so that means I'll have to figure out, okay, that 113% return can only come if my R3 is 6, right? Okay, so if my R3 is 6, then in that case what I have to do is basically when I'm setting this is already determined from a previous calculation. Now when I come here, my entry price is determined, 99.70 I'm entering at market and I'm exiting at 0.99. I've taken the average loss and made sure that I determine my position size based on the average loss. Okay, now I have and the stop is also determined. Okay, now the question is, where should I put my take profit? Where does that decision, how does that get solved? For that you use your target R3. Your target R3 is 6. Okay, now remember, position size has already been decided in such a way that going long at 99.70 and stopping at 0.99 will lose only $41.6 thousand. Okay, this is clear. Now the take profit you decide in such a way that given that your entry is at 99.70, the take profit, whatever be the take profit X, okay, you will set that take profit in such a way that the distance between this 99.70 and this take profit, let's say it's 104, let's say. Okay, so you will calculate how much Swiss franc profit you make if you exit at 104, let's say. Are you following? Okay, how much Swiss franc profit do you make if you enter at 99.70 and exit at 1.04? 104 means 1.04. Okay, we can't even see it here. Okay, if we exit at 1.04 take profit, then you calculate the Swiss franc profit, then divided by that 1.04, that will come to a dollar figure.
Yes.
That dollar figure should be 6 times the 41.667, because that's your average loss. 41.61667 is your average loss, and you have calculated that in order to deliver 113% return on invested capital, you need to have a R3 of 6. So if your average loss is 41.66, that means your average profit has to be 6 times this, which means this. Okay, so that's why now this is how the R3 helps you to determine. We had never really discussed this decision problem, the solution to this decision problem before. So in a way, it's a new thing we are discussing today. Are you following what we have just discussed? That for those who are not willing to use trailing stops, those who want to separately solve the decision problem of exit at profit. You remember exit at profit?
Yes.
That is one decision problem. Where should I exit at profit? Should I be happy with $80,000 profit? Okay, what this system is telling you, what these calculations are telling you, you followed now how the TP level is to be decided. If you do at 104 and you find that the R3 is coming to only 5, that means 1.04 is not high enough. You have to go higher. Are you following? If you are trying to exit at 1.04 and you find that once you exit here, you calculate the potential profit and you divide that by 41.6 thousand, and you find that the multiple is only 5. But 5 is not good enough because you need a multiple of 6 to achieve your 113% return, right? Are you following? You guys are following? Okay. So that's how the R3 calculation, which comes out of your ex-ante system calculations, that's how the R3 is used to determine the place where you place the the level at which you place the take profit. Yes, is it clear? Listen to it once again and figure out. Yes, you have a question now.
Sir, can I up and down?
Yeah.
Sir, like we are having an assumption that we'll be
not having an assumption, making an assumption.
Making an assumption that we'll be that the exit price will be somewhere around 104.
That is just a trial and error method. That is my first trial for my trial and error method. I just picked a number arbitrarily. We can do this calculation right now. Let's do it right now.
Sir,
okay. So let's say now we are doing it for a different market. Okay, let's do it here itself because it doesn't matter. Swiss franc, I'm entering at 99.70. Okay, I'm exiting at 99. Okay, what is my position size? I have to make sure that if I'm exiting at 99, okay, whatever is the position size, it has to be such that, so here it will be, let's not do this calculation right now, but let's just tell you what are we going to do. We are going to calculate X. Basically, you have the formula already in your spreadsheet, right? In your notes also, that whatever is the position size times this times the difference between these two, which is 0.007. Okay, position size times the difference between these two will give you a Swiss franc loss figure. Remember, that's a Swiss franc loss figure because terms asset is Swiss franc. You have to then divide that by the exiting dollar Swiss rate, not by 99.70, the exiting dollar Swiss rate, to arrive at the dollar loss figure. And that dollar loss figure should be equal to 41.667. Yes, this is there already. This formula is already there in your sheets. Okay, we are not doing the formula once again because I don't have the sheets in front of me. But anyway, so we can calculate this. All right. So we have a dollar figure. Okay. Now that dollar figure, what are we going to do now? Let's say this dollar figure is, so if it is, let's say, let me try and mentally do that. This is position size into entry minus exit, okay, divided by the exit, okay, is equal to the is a dollar loss. Okay, so if you have dollar loss into exit price divided by entry minus exit. Okay, I just didn't, okay, weird. So we have dollar loss. Are you following what we are doing? Dollar loss into exit price is one thing. Okay, dollar loss into exit price is one thing, and we have to divide it by ABS of, it's nothing, it's just the formula that I'm doing. I'm just trying to rewrite the formula here, mentally calculate the formula. This is, I need ABS, so let's make it ABS minus, you're following what we are doing? Position size into ABS entry minus exit will be the Swiss franc loss. That divided by the exit price will be the dollar loss. So dollar loss is on RHS. Now I need to basically put the position size into the LHS. So I'm multiplying the dollar loss into the exit price, and then I'm going to divide that by the ABS of the entry minus exit. It's easier if you do it on pen and paper, but I don't have pen and paper, so I'm doing it mentally. Okay, yeah, so 1 minute. So ABS of this, so now one sec, now this should give us the, now if I take the dollar loss into the exit price and I divide it by the ABS of the entry minus exit, that gives me this dollar figure. Okay, and then if we calculate this, it should come out. Yes, what is your question? Are you following?
Sir, actually,
yeah, you tell me your question. I'm listening to you.
Assumption of 104, and according to that we have a R3 of 6.
No. We don't know. We are going to do that exercise. We don't know because I just took 104 as a random number. Okay, I just took 104 as a random number. What am I doing here? I'm cross checking that figure I got. I got a position size figure of 5.8 something. I'm cross checking that. Now I'm taking that position size, multiplying by ABS of entry minus exit, okay, then dividing the whole thing by the exit price. Okay, that should be, so the figure is correct. Okay, what is this 41.250? Okay, that is one of the components, so it's not a big deal. We can make it a little smaller. Yeah, we'll make it a little, this will be small data. Instead of big data, this will be small data. Okay. Are you following now what we did? We took our example where we are going long dollar Swiss at 99.70. We are exiting at 99. And we are now we have to deal with that other decision problem. What should be my position size? Pulkit is also falling asleep. Now what happened to Adarsh? She's gone out. Pulkit, also come here. Come here. You're falling asleep. Get some activity. Walk around. Do some calisthenics. Run around the class. Whoever's falling asleep, we should make them run around the class, and then they'll wake up. So you can come and sit here. Come and sit here next to Adarsh. Okay, you will become more idealistic if you sit next to Adarsh. Okay, all right. So yes, 1 minute. I'm just coming to your question. You followed what we did. I was going to go long dollar Swiss at 99.70 and exit at 99, but I have another decision problem to solve. What should be my position size? What is the constraint that I have to deal with while deciding this decision? While solving this decision problem, I have a constraint sitting on my head. The constraint is my maximum loss must be only 41.6k. And in this case we are setting it, although we call it maximum loss, so it could be less than that, but we are setting the average loss equal to the maximum loss for the sake of simplicity. So my loss should be exactly equal to 41.7k, right? Using that constraint, I solve for the position size. So here I am modeling the position size as a function of the entry and exit prices and the maximum dollar loss figure, right? Yes. So this is our position size, and we have cross-checked it to see that it is coming out to the same figure. So this position size is correct. Okay. Now this is my position size. Now I still have another problem to deal with. That's where your 104 comes in. Okay. That I need to basically, having entered at 99.70, assuming I don't get stopped, then if it keeps on going higher, at what point do I exit? That's also a decision problem. For those who don't want to use trailing stops, you need to actively select a limit price. This will be a what kind of order? Limit sell order. Okay, because I've gone long, so my take profit will be a limit sell order. So when you place a bracket order, there will be one will be a stop order and one will be a limit sell. Both are sell orders. One is a stop sell, one is a limit sell. The take profit is a limit sell. Okay, so now the question is, what should that limit price be? The limit sell order, they'll ask you, it has one parameter. Limit order has one parameter, which is what is the limit price. Okay, so that we said randomly I took a number 104. We are coming to that now. Okay, so now there also I have a constraint to deal with. I can't just randomly decide that I'm going to exit at 102 or whatever, because I have another constraint to deal with, because my investor wants a 113% return. Based on the dynamics projected for my system, I can only get 113% return if I have a R3 of 6. If an R3 of 6 with an average loss of 41.7 means my average profit has to be $250,000. Okay, right? So now what I have is, I have another equation to set up, which we can now actually set up. We have never done it before, which is we have to, are you following the problem? I have to now write the limit price, which is my take profit level. My take profit level should be, now I have to model the take profit level as a function of my entry price, my target profit, which is this. My target profit is also mechanically derived from the average loss and the target R3. Yes. Where does this 250,000 come from? It is 41.7 into 6. Average win is coming, given that my R3 needs to be 6. Okay. So therefore, given that my average loss is 41.7, my average win has to be 250k. Okay. you can check it once again, that if you do 6 into average loss, you will get 250k. Is this clear? Okay. So now what I have to do is, now I have another problem. So what do I have to do in layman's terms? In plain English, you see how we move from plain English to a mathematical model, okay? So in plain English, what is my problem? I need to figure out what is that level, 101, 102, 103, 105, what? What is that level at which I will achieve a R3 of 6, which is another way of saying that I need to achieve a total profit of 250,000. Okay, so now I have to model that level that I'm looking for, that is actually the limit price level for my sell limit order, which is my take profit order. That price that I'm looking for. So now I have to model the limit price level as a function of the position size, the entry price, and the targeted absolute profit on the trade. This is clear? Okay. Are you following? We are not following clearly, I think. Maybe Puneet also should come next to. We have separated him from his buddy, so now his brain is not working. Half his brain is working. Yes. Okay. Yeah. What is your question? Are you following the structuring of the problem?
Yes,
Yeah.
Except the question, sorry.
Yeah. I delayed your question. Sorry. Yeah. Go ahead.
Except the profit amount told or requested by investor. Everything is done on assumption basis.
Yeah, see, in this, what I'm saying is, this is an ex-ante analysis. That's why I said, when you talk about things like system edge, percentage losers, there is a ex-ante and there is a ex-post. Because see, when you are trading, when you are going forward in trading, when you do these, you have to do these calculations at the beginning of your trading period. Because otherwise, how will you know what is the average amount you should be risking on a trade? So there is an ex-ante planning that has to be done. Planning obviously always is ex-ante. Okay. So the ex-ante analysis has to be done. Now after the period is over, you can also do a ex-post analysis. You should actually and compare that I was budgeting for a average loss rate of 75%. What was my actual realized average loss rate? Maybe over the last 1 year I have only had a loss rate of 61%. But although I had budgeted for 75%, that's okay. But the reverse is not okay. You should not budget for 61% loss rate and then have 75% loss rate. That's why you want to budget very conservatively with a high loss rate, so that your loss rate is always less than your budgeted. Okay? Profit should be more than budgeted. Okay? So are you following? So this is an ex-ante analysis, because you need to do that. Otherwise, how will you know what is your average risk per trade? This is the most important number in any kind of risk book management. Any kind of fund management situation, actually, this is the most important number, and how you determine using this number to constrain your position size. See this one, this trade that we are doing, 99.70 buy dollar Swiss, stop loss at 99 figure. Okay, that 99.00 is called 99 figure. That the fact that the position size here can't be more than 5.8 million, and it's coming out of this number. Okay. This is the most important aspect of your risk management, making sure that your position size is controlled to make sure that average loss numbers are not broken. And then of course having the stop order in the market, so that your actually also in practice the order is executed when it goes below 99. Don't just watch it from the sidelines, because when you're losing money, okay, that's why I told you before, I think, that always stop orders must be always in the system. They must be placed into the system, okay? Because if you are watching when the market is going through 99 and you're losing money, you may not have the guts to pull the trigger, okay? So you will freeze sometimes, because you realize that when you pull the trigger and exit, you'll realize a loss of 41.7k, okay? You may not want to realize that loss. So you will hesitate. These are all the human weaknesses that come in. So you have to basically, that's why the rule is that you should put the order into the system. Okay, and not disturb it. Yes.
Can we change our assumptions while trading? Like, I have made an assumption I am going for 75% loss, and during the trading period, I am observing that okay, the market is going on a good rate, and I can change my assumptions. So,
no, actually, I would recommend that you don't. You can always change it. Nobody's stopping you. Okay, like you can always eat 10 eggs for breakfast. Okay. But the point is that you should not do it. because for this, remember, yeah, I use the word trading period. I'm not saying trading year or trading quarter. I'm giving a general definition of trading period. So as a basic, as a matter of discipline, you should not change it within the trading period. Okay, so if you want, you can work with, let's say, even a quarterly trading period. So that's a reasonably tight period of time. So based on your first quarter's experience, you may want to change the ex-ante assumptions for the second quarter. But as a rule, inside the trading period, you should not change it, because that is taking you into the domain of arbitrariness. This is just like when we say that the students cannot come out before, must enter the hall before 15 minutes, but then Pulkit comes with only 13 minutes to go, but we say, okay, Pulkit, fine, come. This is arbitrariness, okay? It's because we already declared. Now, if we want to change that rule, we can change the rule in the next semester. Okay, so as a basic system, you should never change your rules within the system, within the period for which the rules were designed. Okay, are you guys following the discussion so far? Yes? Okay, so now what I have to do is, I still have this other problem, that where should I place my, where is it? The data is, now it needs you to look at it, otherwise okay. So what is the other decision problem that I have? So what we were getting at is, I was trying to lead you from the decision problem and the layman's statement of the decision problem into a actual mathematical model where you are modeling the position, you are modeling the limit price level for the take profit order as a function of the position size, the target absolute amount of profit, and the entry and exit prices. This is clear. So let's write that equation first because we have never written this equation. Okay, let's write this equation first. Maybe we can copy from some of these, then never mind, we'll just write it again. I'm always looking to copy and save myself some work. Okay, we are in a totally different kind of discussion today from what was actually planned. Yeah, this we have already discussed, okay? This is what we had today. Okay, today is 1410. Okay, so we are having a lot of discussions about high loss rate of predictive models. See, what is the message we gave? Still okay if R3 is high. Yes, this is the message we gave you today. Even if your predictive model has a high loss rate, that is percentage loss, percentage losers, okay, still okay if the R3 is high. Yes, okay. Now what are we discussing? Let's put the formula here. Modeling the limit price, modeling limit price for take profit order. Yes, okay, as function of, remember this is how you have to use the lingo, okay? Modeling the limit price, typically whatever you're modeling is in the LHS, typically. You can always put it in the RHS also, but usually we put it in the LHS. Modeling the limit price for the take-off break on one side of the equation, basically. So as a function of, okay, function of 1, position size, 2 is, what is the next one? Entry price, okay, and we can't put the exit price because the exit price is what we are modeling. Remember, the exit prices are unknown. Should we exit at 102, 103, 105? That's our unknown. Okay, so entry price, and what is the third one? Targeted absolute profit on trade. Okay, and this also is coming out of this. I don't need to write because you should watch the video. Targeted absolute profit on trade in turn is derived from average loss times targeted R3. That 250,000 that we need to make on this trade as profit is coming out of the 6 of the R3 is equal to 6 and the average loss is equal to 41.7. Okay, so this stuff is in your notes. I'm writing it in your notes, so you don't need to write this. You need to understand it, follow what we are doing. How we are going from an actual decision problem, you can identify with the decision problem. Yes, you can see the decision problem, that since you have gone long and you're not getting stopped but the market keeps on rising, at what point do you take your profits? That's a decision problem. That should not be decided arbitrarily. That is also to be decided in a structured manner, as to be consistent with the rest of your system. Okay, so therefore you have to now model the exit price, the limit price on the take profit order as a function of your position size, entry price, targeted absolute, profit on trade. What should happen? How should we write it? Okay, let's write it this way. Let's write it as EXP, exit price. This exit price is going to become our limit price, the parameter for the limit order. Okay, the limit price at which we will sell. The exit price, what happened? You've gone back to your own place. Huh? Okay. All right, so the exit price. Now the exit price is equal to, okay, let's write first. We should write one thing. Let's write the okay, let's just, instead of writing ABS profit, let's just write profit. What is the profit? Profit is equal to position, okay, into ENP minus, actually I should write it in some other way, EXP, this way. So into ABS ENP minus, are you following what we are doing? What is going to be, first I'm going to write the profit and then I'm going to interchange and come to the, take the positions, take the exit price into one side. Okay, so the profit on the trade is going to be position size times absolute difference between ENP and EXP. Yes, and what else into this, and divided by the whole thing has to be divided by, yes, exit price. The whole thing has to be divided by EXP, because this is, what market are we trading? Dollar Swiss. So dollar Swiss, what is the terms asset? Swiss franc. So profit and loss is always in the terms asset, remember that. If you ever forget, remember when you are going and trading sugar, if you are buying 100 tons of sugar at 20 rupees and selling 100 tons at 35 rupees, your profit is measured in, not in sugar but in rupees. Yes? Okay, so profit is always, and when you're trading sugar, what is the terms asset in India when you're trading sugar? Indian rupees. Okay, so from that you should be able to remember that profit is always in, PNL is always in the terms asset. So here the PNL is in Swiss franc. So Gulati, are you following? That therefore this is not sufficient to write profit is equal to position, because this profit is dollar profit. This profit we are talking about is dollar profit.
So the position is the total or the average?
No. This position is what we determined here. Remember, we determined that the position can only be this here. This 5.8. The position can only be 5.8 because if I'm entering at 99.70 and exiting at 99.00, okay. If these are my entry and exits, and I don't want, and my loss should be exactly equal to 41.7, then that is only possible if my position size is 5.8. So that's the position I'm dealing with now, because that's what I've entered. Now the market has started to move in my favor. At what price should I exit to be consistent with the rest of my system? Okay, so therefore now it started to go up. Where should I exit? I'm modeling. I don't know the answer to that. I need to derive a structured answer to that. So I have to model the limit price for the take profit order as a function of the position size, the entry price, and the targeted dollar profit on the trade. Okay, and the targeted dollar profit on the trade is coming from the required R3 times the average loss. That $250,000 target that we have for this trade, profit target for this trade, that is a function that is coming from 6 times 41.7K, which is our average loss, because the target, the required R3 is 6. Are you following? Okay, so this is the dollar profit per trade because our risk capital is in dollars. Okay, now if it is risk capital is in euros, then you replace this with euros. Yes.
Sir, like you just said that it's sort of difficult for us to put a limit order, so can't we use a bracket order, first limiting it and getting it?
No. Bracket order you can use. Typically in TWS, bracket orders they take only with limit price entries. Okay, so let's say that the market was at 1 when you entered a limit order at 99.70. You would have entered a limit buy order at 99.70 when the market was at 1. And along with that limit buy order, you could have also entered a bracket order, so that as soon as the limit order got filled to enter, the two bracket orders would be live. One would be the sell stop at 99.00 and one would be the take profit limit sell order at whatever price you set it at, 102, 103, 105, whatever. That limit price order is what we are trying to figure out, because we don't know what it is. Because it can't be decided arbitrarily, it has to be decided as to be consistent with the rest of your system, to meet your system goals. Okay, because remember, your investor wants a 113% return. That requires you to have a 6 plus 6 R3 of 6. So which means on average your profitable trade should return $250,000 on average. So which means on this trade also you have to shoot for $250,000 profit. Now what is the limit price order? What is the price level at which if you exit that you will earn $250,000? That's what we are trying to find out, right? So we have to model it. We don't know it. We are modeling. So first for that we are writing it this way, but this is not complete. What else do we need? Divided by the exit price. Divided by the exit price. Okay. So now we have a dollar. This gives us the dollar profit. Okay. Now what we have to do is we have to take this exit price out on one side. Okay, so what do we do here? We take this is divided by this. Okay, let's take the exit price to one side. We can write this as, of course this is easier to do on the board. Okay, we can write this in the next. Aurora, are you following? Yes. Okay, so the exit price goes to the it will be 1 by exit price. No, is it divided by exit price? So the exit price goes to the left. Yes. No, yeah, into profit we'll straight away bring the profit down. Okay, and then we will take 1 by profit. Okay, we'll take the profit down. Is this so? Am I doing it correctly? Please tell me if I'm wrong also, because this is a very odd way to do equations, writing it on the Google Docs.
Actually, just switch the position with price and profit rather than writing it by
It's okay. We can do that. Yeah. So I'm saying that you guys can actually can do it better. So what are we doing? But we have to take out this exit price. No, we have to take out the exit price from here also. That's another problem. No. So we have to open this bracket. So 1 by profit is fine, but we have to now write this as 1 by profit into, basically it's 1 by profit into this.
You can remove ABS.
We can remove this. Yeah, okay, we can remove this. So I'm just writing it to that is how we should write it. We'll just ignore the sign basically when it comes. Okay, so we'll remove this in now. We can write removed at Pulkit's request. We'll write it here. Okay, so now here help me with opening the brackets. Position into entry price minus position into exit price. Is that correct? Yeah, you're right. We're removing in this kind of. So basically we write this as, once again we write this as stepwise, because our dear friends who are missing today, they should be able to follow it, because I'm not going to discuss this again. We have to move quickly. You have to revise quickly from, okay, so position into entry price. So let's write this. Okay. All right. Position into entry price. Let me remove this. Okay, we'll write it with nice third brackets. Minus is this correct? Everybody, Gulati, is this correct? We have opened the bracket. We have removed that absolute, so it was only position into entry price minus exit price. So we have opened the bracket and written position into entry price minus position into exit price. This is okay? Okay. So 1 by profit into position into entry price minus position into exit price. Okay. So what do we do? Position into exit price. So we take this here. Okay. So this we rewrite. This is turning into a maths algebra class, basic algebra class. Okay, never mind. But this is what you have to do. Okay, we are going to remove this from here. We are going to bring it here. And here also, you have to be very careful, because sometimes you can just make mistakes. Those calculations which were given to you during the exam, they required you to be familiar with the theory also, very clear about the theory, but also you have to be very meticulous. Many of you forgot to adjust for the Swiss franc PNL. Just straight away calculate it. Your brain has to be switched on all the time.
Right? It's done.
Yeah, you are done it, no? So we'll write it, but I'm just doing it here. So this will go here. We are moving this to the left. Okay. Then 1 by profit into this, right?
So we can take exit price common from the.
Yeah, so that's what we'll do, no? So now we will write this as exit price. We'll write in baby steps so that everybody's clear about it, no? Exit price, we'll write it as into
1 plus.
yeah, we'll write it as 1 minus position.
1 plus position.
Sorry, 1 plus position. Okay, yeah, 1 plus position. And we will just remove this. Okay, so 1 plus position. Now we are okay. All right. Okay. So now we can rewrite this as exit price, and we'll take the 1 plus into. We'll divide this, right? So we'll take this. We'll put this. This bracketing is not correct actually. This bracketing is not correct. But my sequencing of the brackets is not correct. We have to divide it by 1 plus position. Am I correct? Okay.
Then simply multiply profit with 1 plus position.
Yeah, profit. So this becomes essentially that this becomes profit into position. This becomes profit into each position. Okay. It's a little harder for me to see because I'm doing it in this odd way. But yeah, it is profit into position. So it is essentially, what is the RHS? Position into entry price divided by profit into position. Is that correct? Okay. So then we can write now, so what is our exit price? We have to write it as profit into, but we have to just see that the removal of the absolute value, is it likely to create any kind of problem? Here the exit price is higher than the entry price. Yeah, it will not create a problem. So the removal of the absolute value should not create any problem. So what is our exit price? Position into ENP, let's write it as position. What is your position is here, right? What is your ENP? 9970. Yes, let's keep it here. That's 1. How did this become? Okay, fine. And we have to divide it by profit into position.
No sir, 1 plus position into profit.
Yeah, sorry, 1 plus position into profit. Yeah, see, this is where you might, yeah, see, this is 1 plus position into profit. So is equal to, what is the, 1 minute. Yeah, okay. So profit is what? Profit is $250,000. Okay, into 1 plus position. Position is here. Is that correct? Position, this is our position, 5.8. That's the position we took, no? One minute. See, that's why we have to be careful, because we are doing it in a very odd way. So this was one. So this was 1 by profit into this thing. Okay. Then, so we have to do it in, actually it is better because I'm getting very confused with by doing it here. Okay. So 1 minute. Let's look at it once again. Okay. Your time is up, but you understood what has to be done. This you can do on your own. Okay. This you can do on your own. If you do it on an exercise book, it's much clearer. The brackets are much clearer, because I also did not sequence correctly. I put the second bracket before the third bracket. I put the third bracket before the second bracket. Yeah. So I didn't put it correctly. So anyway, so just do it yourself. But you understand this, in this manner we can model the limit price. But what you can understand is that the exit price on profit is not something that has to be arbitrarily decided, but it should be determined in a structural manner as a to be consistent with your system. We will do a quick recap in the next class, but please make sure that those of you who are falling asleep plus those who are not here, they do a quick review, okay? Because we can't repeat everything in the same class. You have to watch the video, right? Yes? What happened? Yes? No, we'll simplify it, don't worry, we'll simplify it. We'll simplify it, okay? We'll figure out we'll do it again in the next class. We will quickly wrap up. I won't repeat things in the next class, but we will quickly wrap up. But it didn't answer your questions. But the question that you're having, Khushbu is saying that she is not able to figure out how to trade, but that problem should not be there. Go and watch the videos once again. You have been given very clearly structured decision problems, and we have given you very clear rules, okay? To some extent, these rules are a little bit simplistic, because this theta is as a function of time to expiration. Strictly speaking, that is only for at the money options. So I've made certain simplifications to give you a structure. In real life, there's no such clear-cut structure, but you can use the structure. The structure is not going to take you very much off track, and it will give you some structure. So you go through the way we solve. I've given you clear-cut ways to solve each of the problems. Yes? Go and revise again. Yeah? Okay. Yeah.
Theta value, but all values always having a higher negative theta value as compared to the
Yeah, there is actually it's coming out of the formula, but we'll check it. You can come. We'll check it again. It's coming out of the formula. Okay, it's coming out of the formula, but we'll check it again. But in fact, the formula seems. I'm going to check that formula once again. These are all partial derivatives. Okay, these are all partial derivatives. So from the structure of the formula, you can see that one number will be always higher or number always lower. Okay. So Kriti has switched it off. You're feeling cold. No, that's okay. I'm going anyway now. Okay. So I'll look at that in more detail and come back to you. Yes.
Sir, the formula is really very, and it's simplified. We just have to write at the end 1 upon 1 plus position, and it will be done.
Okay, we'll do it next time again. I'll also go and look at it, because I'm also looking at it. It's very difficult to do things when you.
This need to be written as 1 upon 1 plus position, and it will be done.
Where are you saying 1 upon 1 plus?
We can write it in a way
here.
1 upon 1 plus position. Like
no, because here we are 1 minute.
We are writing 1 upon profit, so we can write it as 1 upon 1 plus position.
Okay.
Into 1 upon 1 plus position, and it will be done.
We are dividing here by 1 plus position, so which is into 1 plus, which is divided into 1 upon 1 plus position.
Yeah, so
no, you are saying that instead of dividing by 1 plus position, you will multiply by
1 upon 1 plus position. So it will state that 1 upon profit is also being divided by this.
Okay, I'll check it when we go there. It's easier to see it on the exercise book. One is not used to doing equations like this. Yes. Okay.